Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is the 5th of April, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you want a trial or hear more about what we're doing, go to renmac.com or renmacaccess.com to get some insight on that. We're going to talk a little bit about the no labels demise. We're going to talk obviously about payrolls, PMI data, oil, and we'll talk about the market and the expanding breadth. But first, I was going to ask you guys, what are you doing for the eclipse? You doing anything, Steve? I mean, it's already pretty dark down there in DC, but anything going on for the eclipse?
When you have two boys under two, you don't make it outside very much. So probably
Fair.
nothing.
So one of my sons asked, he said, "Dad, can you tell me what a solar eclipse is?" And I said, "No, son." All right. So with that, give it a bit. Give it a bit. Got it? No, son. There we go. Okay. We're going to go right to Neil. I mean, that's a great lead in for Neil and his dry sense of humor. Nothing funny about the payroll report today, though, Neil.
Well, it's not unless you're bearish on the economic situation. It is kind of interesting. I mean, if you just go through Twitter and look up popular bears and how they've been saying that March was going to be some sort of big watershed moment for the job market, like in terms of, weaker growth, negative growth, March, it's going to be something to watch.
Right. The real data because of
I
the
wish
seasonal.
I had no shame and just named those people, but at any rate, I mean, I think it's hysterical. But look, the labor markets are strong. If you look at, forget the numbers that's being published, but look at the Conference Board's labor differential, right? Like if you ask consumers how they rate the jobs market, it's strong. But the number itself, when you take the number of jobs that were created times how long people are working, times how much they're making each hour, that number rose 0.8% over the month. That's really strong. And it's basically a proxy for nominal growth, and it's consistent with about 6% nominal GDP. So inflation isn't anywhere close to that. And if nominal incomes are rising that rapidly and inflation's running, let's say 3%, I think actually lower than that, but let's say it's 3%, it represents a substantial boost to real incomes. And that keeps consumer spending going. And I think the markets, it's an interesting kind of, I mean, there's two things going on here that are kind of at odds, right? I don't think the jobs number in and of itself pushes away the Fed from cutting, in the sense that, just because the jobs numbers are strong, it doesn't necessarily mean that it's going to be, undoing the inflation progress that we saw. I mean, Powell has been leaning into this idea that this labor supply is strong. And, for example, we saw teen participation rates surging this month. But if it's labor supply that's driving things, then it suggests there's a bit of an asymmetry with the way the Fed's looking at the jobs number, right? I mean, a strong jobs number won't necessarily push them away from cutting as much as a weak jobs number would push them towards cutting. So that's the first thing. And I think the second thing is that that's why I still think the Fed's going to be cutting. I still think it's going to happen by June. That's also premised on the idea that inflation is likely to slow between now and then. It's certainly been slowing in most parts of the world, particularly Europe. But what it does do is it makes the Fed's forecast or estimate of neutral of 2.5% look laughable, right? I mean, that's what this, I mean, so that basically means that they can cut a few times, but they can't really do much more than that because neutral's higher. And if they do that, then they're going to be risking, another big inflationary impulse. So that's kind of where I'm at. I mean, I don't think it takes rate cuts off the table. I mean, the markets are priced for a potential hike this year. I mean, I think 15 to 20% if you look at the futures curve after this number. I wouldn't go that far, but I definitely believe that neutral is, probably close to 3.5%, 4%, which kind of, makes it difficult to see the 10-year. I mean, the 10-year may look okay here. I mean, that's kind of where I'm at. So, yeah, but look, the economy itself is fine. We were never worried about the economy, as everyone knows. I mean, I just think it's always fun to kind of tap dance on the most ridiculous bearish people that are out there that are always seeing weakness even when there isn't any. So
So in your view, though, what does this do to the Fed? I mean, if you kind of think about the mandate of, employment and inflation, clearly the employment side of the ledger isn't a problem. Does that lean them more to fight inflation harder?
I mean, why should they fight inflation harder if inflation itself is still slowing?
Well, it's just not to the level that they want it.
But they've told you that they're willing to cut rates without inflation at 2%. I mean, if you're waiting for inflation to be at 2%, you may have waited too long.
Yeah, I understand that, but just the question being, there should be some type of dance between the two of these things, right? And clearly you're not impacting the labor market now. Good question, which Steve would ask is, is there some influence that we're seeing here from immigration? Is that part of the labor story?
Yeah, but the only reason that question's being asked is because we're talking about an even numbered year.
Election year, i.e.
Yes.
Yeah. All right. Well, with that, let's go to DC. So we got the plug pulled on the no labels party. I don't know that that's a big surprise to you, Steve, but what are the implications of that? In terms of you're always on follow the money. If we follow the money, what is that telling us?
Yeah, no labels has no candidate, and that probably shouldn't come as a surprise given that they kept trying and reaching out to multiple people and were rejected each time. It just reinforces the fact that you're not going to see a candidate be elected president that's not from either the Republican or Democrat Party. In terms of who benefits from this, I think it's RFK Jr. I think in some ways his candidacy sort of took off. It may have dampened some of the enthusiasm for this whole no labels, big name idea. So that's good for him. It's probably good for Joe Biden. I think polls show that there is a lot of enthusiasm for people to vote against Trump. There is clearly less, some would argue, if any, enthusiasm to vote for Joe Biden. And I think that's where you see, to your point, following the money, Democrats spending very heavily to keep RFK Jr. and other third-party candidates off the ballot because we see in these battleground state polls when they're included, Trump performs better. And intuitively, that sort of makes sense because if you're voting against Trump and you have more options, then and you're not that enthralled with Biden, that is going to be at the detriment of Joe Biden just because polls also show that Trump's support is very stable. His floor and his ceiling aren't really that far apart. And I think that's where the Democrats are spending a lot of money to keep Biden off the ballot. They spent some money earlier to try to keep Trump off the ballot. So follow the money.
And speaking of money and the impact that has on the election, I know gasoline prices are up, and some concerns around potentially spreading in the Middle East. How are you seeing that in terms of the impact, excuse me, not only on the polls, but the potential disruption as we go forward throughout this election year?
I think markets have largely dismissed geopolitical risk that have been gathering for a while, some time. I think you have some more recent developments where, again, just the combination are maybe starting to weigh in on some factors here. If you look at Ukraine, you have Ukrainian forces launching attacks into Russia at their energy facilities. If they start going to the export facilities, and that might have the potential to disrupt supply. So far, they haven't. But if you can launch attacks into Russia, doesn't mean it demonstrates that you have the capability to do that. You can't fault the Ukrainians because they're waiting on a bunch of aid from the US that's not coming. So, if you're asking them to fight a war, you're not going to help them out. Eventually, they may take matters into their hands. If they think Donald Trump's going to win and offer Putin more favorable terms, they might go ahead and try to take out those export facilities to try to change the flow of the war, which candidly right now is not going in their favor. And then with the situation in the Middle East, you have Iran threatening to do a direct attack now against Israel. Some believe that Iran could increase their production facilities to try to fund their proxy efforts. But there's also the risk that Israel just decides to take out Iranian oil facilities. Maybe they even go and do some targeted attacks there in Iraq. Obviously that's not going to go over well in the U.S. As you sort of mentioning, gas prices, something I think Biden in particular is very sensitive to. Doesn't want to see them going up. Now we're having warmer weather. There's some seasonal fluctuation associated with that. But right now it's not something that the administration wants to do. And unlike 2022, when you had concerns about high gas prices at the time, the Biden administration tapped the Strategic Petroleum Reserve. The problem right now is it's tapped out, and with OPEC not adjusting their production levels, the administration hasn't really refilled it that much. So I think it's at a dangerously low level, and I'd be surprised if they try to tap it again. But I was surprised, candidly, that they did it as much as they did the first time.
Yeah, well, certainly we're seeing that movement in energy names here in the States. It's interesting because the energy sector on an equal weight basis, which is how we look at things, is really kind of middle of the road. It's got near-term momentum. The trends haven't changed yet, but certainly there are areas, marketing, refining, some of the transportation names look fantastic. And, we're incrementalists. When we don't see it fully in the sector and, have a big bullish call on the sector, the way that we play it is by leaning into those names that are showing the leadership. And that's certainly what we're seeing out of energy. We're also seeing the same thing in materials, right? Materials generally overall are in pretty lackluster trends. The relative performance, at least, is still in a downtrend. Maybe some indications it's going to neutral. But within materials, clearly things like aluminum, things like copper, some of the specialty chemicals look fantastic. And I think, part of Neil's commentary on the overall economy is we're seeing that play itself out in the markets through the internals. We had roughly 83% of the names in the S&P 500 making above, I should say, their 200-day moving average. And that's a good number. Some people will look at that as being overbought. If you look at the stats historically, that's not the right call. Overbought is actually momentum. And in particular, when that number is ascending, in other words, it's going up, 83 going to 84, 84 going to 85, et cetera, that tends to be bullish for the market. It means there's more broad participation and things generally continue for the price indices. Where it gets more dangerous and interesting, frankly, is when that number is contracting and the market continues to ascend. And we saw that 3 years ago. That number peaked out back in basically May of 2021, continued to see the S&P climb for the next 6 months as the percentage of names above their own 200-day moving average was in a steady decline, actually, right around 70%. I might have been below that by the time the market peaked out. So clearly a divergence where you were losing support of several names, even though the market was going higher. That's nowhere near where we are today. And one of the affirmations in our view anyway, as to why we think this bull market is still strong. Neil, we've joked for, I don't know, months now about, the PMI popping above 50 and watching bears' heads explode when that happens. We did get that earlier in the week, and now it's kind of lost its luster because it was so long ago versus payrolls. But any commentary from the isms this earlier this week that good, bad, indifferent, anything out of those numbers that you found notable?
I mean, manufacturing's picking up because companies cut inventories to the bone last year and consumers are still spending on goods. So even if inventories were basically cleared out as if there was a recession, and now there isn't one. And so companies have to kind of adjust a little bit on the other side of that, and that's going to support factory production. At the same time, global growth is picking up, right? So if a lot of what we export is manufactured goods. And so you would expect manufacturing to do well if the rest of the world is doing better. Obviously, the market's latched onto the prices paid index within the ISM, but I would just point out that the ISM prices paid is basically a proxy for energy prices, right? So it doesn't really tell you much beyond what energy prices are already telling you. There's a very strong contemporaneous correlation between those two series. But I think what's important is that there's very minimal pass-through historically from commodities to core PCE inflation, which is why if you look at the correlation, ISM prices paid tends to have the best correlation with the producer price index. and a very, very weak correlation with core PCE. And that kind of speaks to this idea that there's a lot of slippage along the supply chain. And I think it's important for, just to point out, like corporate profit margins are a lot higher now than they were a year ago, right? And so if you do get this kind of input cost pressure with oil prices going up, it remains to be seen whether that's passed on right away to the consumer, because companies have a little bit of room to eat the cost because their margins are higher. And so, we already see evidence that consumers are kind of making that price and quantity trade-off, right? I mean, so areas where you're seeing prices go up more tend to see people spending less in real terms, and where prices are going down, people are spending more. And if people are making that trade-off, then it's going to be it's difficult to kind of talk about real. I mean, if companies are trying to pass through the costs, then it may just mean that they lose out on volume as a result. So
Well, the services prices paid actually contracted pretty notably from 58.4 to 53.4. I mean,
yeah,
do you look at that as being an offset to the traditional PPI?
sure. I mean, well, yeah, you have to kind of take all the data as it comes to you. But if I mean, services, that's where the lion's share of activity happens, and that's what the Fed really cares about, right? Service sector inflation, excluding housing. And if that's getting better, then it justifies this easing of policy, this modest easing of policy that they have baked into their summary of economic projections.
All right. Well, with that, what do you have next week on the calendar?
Well, next week we have CPI. Speaking of that, the
Yes.
market's looking for 0.3% on core CPI inflation. We'll also get producer prices coming out, and we'll get the first cut at the University of Michigan consumer sentiment data. I'll be keeping an eye on inflation expectations. As I've been pointing out, it's been notable that inflation expectations haven't really moved despite gas prices going up. And I think part of that, frankly, is a function of other commodities not really doing what oil has been doing. Okay, like, so if you look at retail gasoline prices, yes, they're up, but natural gas prices during that time are actually down. Like, what do you think matters for household utilities? Like, most of US electric, I mean, like, I think 40% of US electrical production is driven by nat gas. So that's going to bleed into what people pay for utilities. If you look at agricultural commodities, for example, they've been, kind of moving sideways, maybe slightly down. I mean, it's not doing the same thing that oil's been doing. So that would suggest that food prices are probably coming down somewhat. So, retail gas is something that people are used to every day. I mean, it's a very visible price, but it's also important to remember that the relative importance of gas prices and utility bills are basically the same.
I
So,
would say people in the spheres that I travel in are concerned about gold, they're concerned about silver, they're concerned about copper. That could all be part of the global story. What's interesting from a sentiment standpoint is when we look at positioning, these appear to be driven by big commercial institutions, whether that's central banks with gold. It's certainly not the small retail trader that's driving gold. They're not the same people that are driving copper. So I'm not sure if that's part of the AI play in the food chain. I don't know exactly what is happening there, but that's one thing that the inflationists are certainly from my seat pointing out, in terms of what the market is trying to tell us. Steve, what do you have on the docket next week?
Domestically, Congress comes back. I think they're probably going to focus on FISA reauthorization. That's sort of the surveillance law for those of you who aren't familiar with the acronym, because there's still not consensus on what to do with the security supplemental push. Could happen at the end of next week, may get delayed the following week. And then internationally, we have Treasury Secretary Janet Yellen still in China. I think she's really over there to try to push back on China's sort of industrial policy right now in terms of trying to flood the market with a lot of cheap exports, try to boost their economy. In terms of the green energy concerns for the Biden administration, that's a problem. So we'll see where the two sides land there. And then I believe Biden's also going to meet with the Japanese Prime Minister, who I'd be surprised will not raise the question of the Nippon Steel potential acquisition of U.S. Steel, which has been a hotly debated topic here with a lot of political ramifications we've discussed. So I'd keep an eye on those things.
All right. Well, we're certainly going to be watching the key levels for the S&P. The 50-day, which is ascending at 50.76, an important level in terms of really containing any type of weakness we suspect in the market here without much sign of distribution. Bitcoin 63,800 is the next support level, and the 10-year yield right at this resistance level 440. We'll watch that carefully. Clearly more resilient than what we've been anticipating out of the 10-year yield, given what's happened to global yields. 403 is the support level on the downside. All right, I have one more Eclipse joke. It does not have a punchline, but it just leaves you in the dark. So join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter for updates. And if you want some deeper insight, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
We'll see you.